Today, my name is Jessamine Mendez. First, I'm going to discuss about the role of money. So, money has different rules depending on our purposes. The first rule of money is a medium of exchange. It allows people to obtain what they need to live. Bartering was one way that people exchanged goods for other goods before money was created. Like gold and other precious metals, money has worth because for most people, it represents something valuable. Here's my example for the first rule of money as a medium of exchange.
Jessa, this is your salary.
Okay, thank you, sir. Finally, I received my salary now. I already have money to buy my favorite clothes and I'm going to school.
Next, money is considered a store of value, where it can be used as a means of saving and allocating capital. Money's property as a store of value facilitates a transfer of purchasing power over time. Here's my example for money as store of value.
Anak, this is your allowance.
Thank you, Pa. Since I have extra money here, I will keep this money here.
And the last one is a unit of account. A unit of account is something that can be used to value goods and services, decorative and make calculations. Money is considered a unit of account and is divisible, fungible, and accountable. With money being accountable, it can be account for profits, losses, income, expenses, debt, and wealth. The next topic is about interest rates. Interest rates are the price you pay to borrow money, or on the flip side, the payment you receive when you lend money. There are such things as negative interest rates, where you instead get paid to borrow money, but these are rare. Interest rates are generally framed as percentages. Each year, you either pay if you're borrowing or receive if you're lending. This percentage of the total amount of the loan. For example, for a 20,000 loan with a 10% interest rates, the borrower would have to pay the lender at the end of the year. Interest rates are one of the most important numbers in the economy because they influence how likely people are to borrow money. If interest rates are really high, it's expensive to borrow money. When they're low, it's much cheaper. When people borrow money, they're usually using it to invest in big things like a house or a new business. These investments ripple to the rest of the economy and can be both job growth or even wages. This is why economists are so obsessed with interest rates. This one number can be thought of investments with low rates or slow things down when everyone's getting a bit too excited with high rates. Here's my example video for interest rates.
Hey, Jessa.
Yes, sir. Good afternoon.
Yes?
Actually, sir, I am here to owe money from you.
How much?
30,000, sir.
Okay, there is 5% interest, huh?
Sir, thank you, sir.
Welcome.
My third topic is about the unemployment and inflation. The relationship between inflation and unemployment has traditionally been an inverse correlation. However, this relationship is more complicated than it appears at first glance, and it has broken down in a number of occasions over the past 50 years. Since inflation and unemployment are some of the most closely monitored economic indicators, we'll delve into their relationship and how they affect the overall economy. When unemployment is high, the number of people looking for work significantly exceeds the number of jobs available. In other words, the supply of labor is greater than the demand for it. Let's stick with inflation. Wage inflation rather. The rate of change in wages as a proxy for inflation in the economy. With so many workers available, there's little need for employers to bid for the services of employees by paying them higher wages. In times of high unemployment, wages typically remain stagnant and wage inflation or rising wages is non-existent. In time of low unemployment, the demand for labor by employers exceeds the supply. In such tight labor market, employers typically need to pay higher wages to attract employees, ultimately leading to rising wage inflation. Over the years, economists have studied the relationship between unemployment and wage inflation as well as the overall inflation rate. The Phillips curve was one of the first economists to present compelling evidence of the inverse relationship between unemployment and wage inflation. Phillips studied the relationship between unemployment and the rate of change of wages in the United Kingdom over a period of almost a full century from 1861 to 1957, and he discovered that of unemployment and the rate of change of unemployment. Phillips hypothesized that when demand for labor is high and there are few unemployed workers, employers can be expected to beat wages up quite rapidly. However, when demand for labor is low and employment is high, workers are reluctant to accept lower wages than the prevailing rate, and as a result, wage rates fall very slow. A second factor that affects wage rate changes is the rate of change in unemployment. If the economy is booming, employers will bid more vigorously for workers, which means that demand for labor is increasing at a fast pace. For example, percentage of unemployment is decreasing rapidly than it would if the demand for labor were either not increasing. Example, percentage unemployment is unchanging or only increasing at a slowly pace. Since wages and salaries are major input costs for companies, rising wages should lead to higher prices for products and services. Here's my video example for inflation and unemployment.
How much is this one, Kuya? 120 pesos?
Yes, ma'am.
And this one is 99 pesos?
Yes, ma'am.
So expensive na, no? Sa bagay, nowadays, the unemployment rate increases. So, as unemployment rate increases, the inflation also is increasing. Whereas before, the unemployment rate gamay ra or gamay ra siya, so the inflation also is mga barato ra before long time.
This topic is about monetary policy and fiscal policy. Monetary policy refers to central bank activities that are directed toward influencing the quantity of money and credit in an economy. By contrast, fiscal policy refers to the government's decisions about taxation and spending. Both monetary and fiscal policies are used to regulate economic activity over time. They can be used to accelerate growth when an economy starts to slow or to moderate growth in activity when an economy starts to overheat. In addition, fiscal policy can be used to redistribute income and wealth. The overarching goal of both monetary and fiscal policy is normally the creation of an economic environment where growth is stable and positive and inflation is stable and low. Crucially, the aim is therefore to stir the underlying economy so that it does not experience economic booms that may be followed by extended periods of low or negative growth and high levels of unemployment. In such a stable economic environment, householders can feel secure in their consumption and saving decisions, while corporations can concentrate on their investment decisions and making the regular coupon payments to their bondholders and making profits for their shareholders. The challenges to achieving this overarching goal are many. Not only are economies frequently buffeted by shocks, such as oil price jumps, but some economists believe that natural cycles in the economy also exist. Moreover, there are plenty of examples from history where the government policies, either monetary, fiscal, or both, have exacerbated an economic expansion that eventually lead to damaging consequences for the real economy, for financial markets, and for investors.